If you've been watching the digital asset space over the last few years, you've definitely noticed that it's been totally dominated by these massive, incredibly loud cycles. I'm talking about the crazy meme coin frenzies, the platforms built on pure speculation, and those flashy marketing campaigns promising you the moon. But right now, we're actually in the middle of a fundamental shift. The whole Wild West phase is ending. We're moving away from that pure chaotic speculation and entering what's being called the infrastructure era. It's a massive pivot where true value is shifting to robust, durable systems that are genuinely built to last. Welcome to The Explainer. Let's get right into it. Most people chase hype. We build legacy. I absolutely love that quote because it perfectly captures the mindset shift we're talking about today. Anyone can spin up some noisy marketing campaign and ride a wave of short-term hype, right? But doing the hard, disciplined work to build an actual kingdom, a financial system that survives, requires a totally different approach. So today, we're really unpacking this idea that chasing hype is basically a relic of the past, and architecting sustainable generational legacy is the new baseline. So here is our roadmap for today's explainer. We're covering 1. The shift beyond hype. 2. The new infrastructure era. 3. The 4 pillars of ecosystems. 4. The KINGFINITY growth cycle. And finally, 5. Building a lasting legacy. All right, let's jump straight into section 1, the shift beyond hype, moving from spectacle to architecture. For the longest time, success in his industry was basically measured by sheer volume. It was all about how much noise a project could make, how impossibly fast a token could launch, and just the overall spectacle of it all. Total gold rush mentality. But honestly, that phase is officially fading out. The market is finally growing up, and the new era is defined by a completely different set of metrics. We're entering a period of strict architecture, operational discipline, deep integration, and above all else, durability. It's no longer about a flashy front end. It's all about having a foundational, reliable structure beneath the surface that real-world institutions can actually trust. Because of this shift, smart investors just aren't asking, what's trending anymore? That is totally outdated thinking. Today, they're demanding systems with real longevity. The new questions are, what can scale up to meet massive global demand without breaking? What can seamlessly connect across different networks and traditional platforms? And maybe the most crucial one, what can actually endure through a punishing, multi-year bear market? If a project can't answer those 3 questions with a resounding yes, it's simply not going to survive this transition. Moving right along to section 2, the new infrastructure era. This is all about usable rails for real financial coordination. So the future of digital money isn't going to be some winner-takes-all single model. It's going to be a massive web of interoperable systems. Take tokenized deposits, for example. Major traditional banks are currently taking everyday bank deposits and bringing them directly into programmable infrastructure. Think of it like giving traditional money a really smart upgrade. It's money that automatically executes complex instructions based on code. No human needed to approve it during normal banking hours. This means 24/7 settlement and instant cross-border payments. And just to be clear, this is very distinct from traditional stablecoins. This is the existing banking system fundamentally upgrading its own rails for the digital age. Serious digital ecosystems today are defined entirely by the strength of their operational plumbing. Look at stablecoins. They've evolved way beyond just being digital trading pairs. They are literally the usable rails for real financial coordination now, moving billions in cross-border flows every single day. Or look at exchanges. They're evolving from simple trading websites into massive access networks with institutional custody and deep connectivity. And then you have treasury frameworks. These used to just sit quietly in the background, kind of like an afterthought. Not anymore. Today, they are highly visible layers of trust. Ecosystems are now judged on the rigorous design of their reserves and their resilience under extreme stress. A perfect real-time example of this transition is Pump.Fun. They launched with this massive, incredibly fast-moving, pure revenue burn approach that generated just a staggering amount of initial noise. But here's the thing. Even projects moving at breakneck speeds eventually hit a wall where sheer hype just isn't enough. To survive long-term, they're being forced to pivot towards serious governance. They have to prioritize platform sustainability, actively fund product reinvestment, and maintain strict operating discipline. It just goes to show, no matter how much revenue you print in your first few months, if you don't reinvest and evolve into durable infrastructure, the whole thing collapses under its own weight. Okay, section 3, 4 pillars of ecosystems, the absolute foundation of credibility. According to the KINGFINITY blueprint, there are 4 non-negotiable pillars where long-term relevance is built. First, reliable settlement. Transactions have to finalize quickly and securely every single time. Second, a robust treasury architecture. You need the capital to weather financial storms. Third, seamless access rails, so capital can actually flow in and out without massive friction. And fourth, deep interoperability. Your system has to be able to talk to other networks. It can't just be isolated on its own little island. These aren't just nice-to-haves. If even one of these pillars wobbles, the entire ecosystem is at risk. It is all about being smarter and way more connected to establish absolute credibility. Let's dive into Section 4, the KINGFINITY Growth Cycle, a real blueprint for self-sustaining treasuries. We've been talking macro, so let's zoom in and look at what elite treasury architecture actually looks like under the hood. The KINGFINITY KFX model is essentially a continuous engine where real-world income drives sustainable digital value. And this is huge because it solves the ultimate flaw of most digital assets, constantly needing new buyers to prop up the price. Instead of relying on speculative hype, this model relies on a disciplined, self-sustaining loop of growth and reinvestment. It is mathematically designed to avoid those short-term crashes and create a bedrock of compounding value. Let's break down exactly how this engine works. So, step 1, this cycle begins with dividends. This is real-world income generated from a highly diversified portfolio of assets that actually produce yield. Now, that income doesn't just sit in a vault gathering dust. A strategic chunk of it is used to buy back KFX tokens right off the open market. Because the Treasury is buying and holding these, the circulating supply of KFX physically shrinks. So basic economics here. When you have steady or growing demand combined with a temporarily reduced supply, you get a natural boost in value and market confidence. It's a beautifully logical flow where actual utility and income are in the driver's seat, not just Twitter sentiment. But wait, the engine doesn't stop there. It feeds directly into this incredibly powerful reinvestment phase. When market conditions are right, the Treasury can strategically sell those accumulated tokens at higher prices. And here is the brilliant part. Those proceeds don't vanish into a black hole. They flow right back in to expand the Treasury's underlying assets. More assets mean the Treasury generates even larger dividends. And larger dividends? Well, that means an increased capacity to execute even bigger open market buybacks next time around. It's a literal flywheel effect, continually compounding its own value, totally independent of whatever crazy hype cycle the broader market is currently obsessing over.
And finally, Section 5, building a lasting legacy, transparency, strategy, and discipline.
You simply cannot run a compounding machine like that without some unshakable ground rules. To build a lasting legacy, a treasury has to be rooted in prudent management, meaning the operators are highly risk-aware and looking at the long horizon, not just jumping at quarterly bumps. It requires serious diversification, holding global assets across different sectors so one industry's bad day doesn't tank the whole structure. It demands high liquidity and flexibility to ensure stability during sudden market shocks. And above all, it requires long-term alignment, operating with absolute transparency, building value for generations down the line, not just for tomorrow. Ultimately, the whole paradigm shift we've been talking about comes down to this core philosophy: not louder, smarter, more connected, more durable. The narrative in the digital asset space has fundamentally, irreversibly changed. We aren't in the Wild West anymore, driven by 5-second detention spans and viral trends. The market is maturing, and the serious institutional capital is moving exclusively toward ecosystems that embody these exact operational traits. So, as you evaluate the digital economies you're participating in and the assets you're holding, you really have to ask yourself a hard question. Are they built on fleeting hype, just destined to vanish when the crowd gets bored and moves on? Or are they built with the architecture to genuinely endure for decades? The infrastructure era isn't on its way. It is already here. And blueprints for self-sustaining legacy, exactly like the KINGFINITY model we unpack today, are redrawing the map as we speak. So which side of history will your portfolio be on? Thanks for joining me for this explainer.